Welcome to our session today. Thank you for joining us for Strategic Project Financing, Maximizing Impact and New Market Tax Credits webinar. It is part of our Strategic Financing Speaker Series. My name is Laurel Tinsley, and I'm a partner leading the Strategic Financing Services team here at Bekaert. Strategic Financing Service provides community development consulting. We raise, deploy, and manage capital directed towards underserved communities. In this CPE webinar today, we will guide you through the intricate landscape of project financing using new market tax credits. It's a powerful tool for generating capital in underserved communities. While new market tax credits are a critical resource, they are just one of the many tools in the community development toolbox. I'm pleased to introduce our speakers today. We have Joe Hennessee, who's the leader of our project finance team for Strategic Financing Services. We have David Altman. He's a Strategic Financing Services project senior manager. And we also have Trevor Nelson, a manager with our Bekaert Strategic Financing Services team, and he likes to call himself a deal doula. I'll kick it over to Trevor to begin the presentation. Thank you for joining us.
Absolutely, and thanks for that introduction, Laurel. It is certainly good to be here with all of you. And before we dive in today, just want to give a highlight to the broader platform that is the Strategic Financing team. What you can see is a track record that is a testament to our truly client-focused approach. We've supported more than $1.4 billion in allocations. We've supported over $1.7 billion in placement. And our compliance team is doing almost $1 billion worth of asset management. So we're just not a one-stop shop. We truly cover the full breadth of the new market tax credit process, from the time a CDE has an idea to become a CDE all the way through finding qualities and projects to get done. What we're really proud of is a testament to that work is all of the numbers you see here on the right. We've done over 128 transactions from Alaska to Florida. Truly nationwide, lots of jobs, lots of low-income people served, and lots of real estate improved. And for those of you who joined us around 2 years ago, what you'll notice is across those vectors of impact we care about deeply, we've seen at least a 5% impact. And so really proud of the work that we have been able to do, and really proud of what the results have gone. So to talk a little bit about our agenda, we're going to start with a brief refresher of what the new markets tax credit is. We're going to talk about a lot of acronyms. I apologize for that in advance. One of those is this quality. It depends on who you ask, but the Qualified Active Low-Income Community Business, what it means to be prepared for that, and what it means to have a desirable project. We'll next go on to the capital sources. As Laurel alluded to, new markets is just a piece of what new markets brings to the table. So we'll talk about what factors you should consider when pairing other sources of capital. And then once you put all those pieces together, we have a closing process, right? So we'll go through and conclude with what to expect throughout the closing process. And with that, before we dig in, we're going to go to our first polling question, which is, have you ever heard of new markets tax credits? And as those results have come in, it looks like a lot of people haven't. There's some people who have heard of the new markets tax credit program. So our highest hope is that for those that don't know, you'll get a good introduction. And for those that do know, we'll give you something you didn't know before. So with that being said, we'll start with where the new market tax credit comes from. And the new market tax credit really came off the back of what some of you might be familiar of in the low-income housing tax credit. It was established through the Community Renewal Tax Relief Act of 2000, so just over 2 decades. This is a very formal program that is administered by a department of the Treasury called the CDFI, or Community Development Financial Institution Fund, alongside the IRS. And this is truly public-private. So one of the most unique things is, unlike many other programs, the CDEs, or community development entities, are tasked in acting in the public's interest, but are truly private entities. And we'll talk a little bit more about those CDEs. One other important note I want to give is that the New Markets Extension Act of 2019 gave Congress passed a 5-year extension with $5 billion. As that comes to an end, in order to keep the cycles fluid, the CDFI fund has made a double round. So we'll talk about that again, but just want to reiterate, if you've ever thought about doing a capital project and are thinking about new markets, this will be the largest amount of new markets tax credit authority available in 1 year. So super exciting times for the industry, super exciting times for what's ahead, and our team is incredibly excited. I like to start with the punchline. And the punchline for our team in project finance is, what do the sponsors or qualifies get out of it? And ultimately, what we see on the left-hand side is today, capital markets, I think we can all agree, are all over the place. And you're seeing loan to values go down, depending on the asset type, 70% might need to come from debt and other forms of sources of capital. And then you have that 30% equity requirement. What the new markets tax credit could do is come up with up to 20% in the form of tax credit equity. So that is money, expensive capital you don't have to come up with, and ultimately replacing some of that higher cost of capital that burdens a project. And so that is the punchline, and we'll talk a lot more about how to get there. But before we talk about that, I want to give you some color around where the industry has been and where it is today. So this very colorful graph does something that I think is important. What it shows is that there was a lot of asset types. As you start at the top, right, we talk about hotels and tourism, right? There was a time in the industry where there was a lot of hotels getting done with new markets, arts and culture, right? Mixed use projects, tremendous amount of deals trading in the early days of the program. Now, what we see in recent times is almost half of the industry is funding healthcare and manufacturing projects, right? So I want to stop for a second and just say, our team never thinks a project is bad. I was just in Charleston at a project at the International African American Museum. Arts and culture is an incredibly valuable asset type, but as the process has gotten more competitive, things like tourism, arts and culture, some of the more intangible things to measure from a community impact perspective have just started to get done a lot less. And they still do happen on occasion, but we like to think in terms of what is the most likely thing to get done. And so this visual helps. On the next slide, right, we'll take the most recent information that we got from the New Markets Tax Credit Coalition annual reports, and we have a breakdown on states and asset types. As I just mentioned, as you see, manufacturing and healthcare, large percentage of the projects getting done. Nonprofit hubs are still getting done. You see almost no hotels in tourism. They still do happen very infrequently. I'm actually working on one now, but again, just to give color around what's getting done. And then you can see from a state perspective too. Obviously, the states with the highest population are seeing a lot of deal volume, but there's a whole host of other interesting states that have lots of activity as well. And so just to really articulate what that looks like, I wanted to give examples of different vintages of what projects done. So we have a related community development entity called the NFA Fund, or TIF for short. In the early 2010s, they did the AC Hotel in Spartanburg. Gorgeous project, tremendous community impacts in its own respect. And if we take a deal they just did this year, a minor metro manufacturing creating hundreds of jobs in Georgia. And so that just gives context to how the industry has changed and how when we think about vintages, we're not necessarily thinking about return profile, but much more about impact profile. So on the next slide, we want to talk a little bit about how the New Markets Tax Credit Program works. We use this word application or apply very definitively for the community development entities. So as a project sponsor or a qualified, you don't actually apply directly to any other group other than maybe an application or an intake form with the community development entity. So the CDEs apply to the CDFI fund. Those applications go through a rigorous review and are scored. And just to give context to the success rate, in the most recent round of $5 billion in the fall of 24, 104 out of 196 CDEs were awarded. And as I mentioned before, extremely exciting times. The round to be announced in the fall of 25 is a double round with the most amount of allocation ever. So let's talk about the structure. I've been using this term quality. I've been using a couple of different terms like CDEs, and now we're going to try to articulate where all of this fits in with no numbers. And we know this can be very confusing at first glance. So we'll go through it a couple of times. But just to start at the top of the structure, what we see is the new markets tax credit is a 39% tax credit. I just want to stop there for a second because it's not a dollar for dollar. It's 39 cents on the dollar. And most investors, if they put 39 cents in and got only 39 cents back, that's not a good deal. So early in the program, they came up with what we call the leverage structure, where the 30% of the QEI, because investors aren't buying credits dollar for dollar, are combined with traditional sources that you were already going to put in. So commercial bank debt, equity, grant proceeds, proceeds from a capital campaign or other philanthropic sources coming as the leverage source. They are combined with the tax credit equity into an investment fund. That total investment comes down in the form of a QEI. That QEI is then relent down from the community development entities to the quality. Those are called QLICs, right? Or qualified low-income investments. And that then consummates the actual quality or qualified active low-income community business having those proceeds in a bank account. There might also be a need to finish funding the project, and those proceeds can come direct to the quality in the form of, again, cash from the sponsor, loans, equity, grants, etc. As you see, the only official application process is from the community development entity to the CDFI and vice versa. The QualiB's relationship is exclusively with the CDE and indirectly to the investor who is monetizing those credits. And so again, we'll go through that again, but just wanted to start with this graphic to orient us with all of the stakeholders at play. So as we go to the next slide, what are the benefits of the new markets tax credit for the various folks involved? On the front end, the new markets tax credit is a 39% tax credit that investors can monetize, right? And that comes in over 7 years, which is why, tax credit investors who are typically the largest money center banks, think JP Morgan Chase, TD, Wells Fargo, et cetera, they're not going to pay dollar for dollar. What it provides is flexible and affordable financing to support businesses and community projects. And what the CDEs are looking for is job creation, access to community and commercial goods and services. And so with that being said, on the next slide, just to reiterate, new markets can come in and as I like to call last mile financing. So it can fill 15 to 20% of a project. You pair that with all the capital you've already raised. If you're a nonprofit, think about that capital campaign or a gift that was given. Or if you're a for-profit, loan proceeds, you put those together and the project benefits from things like subordination to other loans, lower interest rates, it's interest only for 7 years, and a portion of the new markets tax credit may not have to be repaid given the structure. Now, to talk about the investor motivations, what we see is, like we've been alluding to, is a 7-year stream of 39% tax credits. And ultimately, what you can see is, the banks look at it and say, hey, I was able to put in, cash up front, reap the benefits over 7 years and get to an internal rate of return. And that's ultimately why they're able to do it, in addition to the Community Reinvestment Act and other community benefits that come from this program. So the math, again, without all of the arrows, we take a $10 million allocation, right? 39% tax credit. That means there's $3.9 million of tax credits to go around. But the investor isn't, again, paying dollar for dollar. And in the market, we're seeing prices range from 75 cents to, the low 80s. And in this example, we're assuming, you worked with us, we got you the best pricing possible. And so the gross equity is $3,159,000. Now, one of the things about new markets is, given the complexity, there are some associated closing costs and fees, and those come out to about $1 million. And so then we have a net residual value, which is a thing our team spends the most time thinking about, of $2,159,000. The reason our team spends time thinking about this is because while there is $3.9 million of tax credits and the gross equity is 3.1, you don't ever see that as a sponsor. The number you're going to see in a bank account after everyone gets paid and all the work's been done is this, what we call net benefit, and is why we focus there. So the next slide will add numbers to the graphic that we had before. We have a $10 million project, 81 cent pricing. the leverage loan amount, which is the money that is coming from your traditional sources, is $6.8 million, $41,000. That is also going to be compared with the tax credit equity of $3,159,000. All of those proceeds will be advanced on the day of closing into an investment fund that is owned by the investor. That investment fund will make the qualified equity investment into the subsidiary, and that subsidiary will then relend those in the form of the QUILICIs that we defined before, one directly proportional to the leverage loan amount, one directly proportional to the tax credit amount, and that will go to fund the mixed-use project, the healthcare project, that industrial project we talked about. And this hopefully gives you a high-level understanding of the structure that's involved. I also just want to call out, there's a lot of nuance around where certain fees come out and how these funds actually flow. And so we like to say it's important to work with a consultant or an expert to help really understand on the day of closing and in the days leading up to closing, how much cash needs to be where and what residual value will actually be left once the closing occurs. So with that, going on to the next polling question, we like to ask, what asset type are you most excited about? Awesome. So it looks like we've got a lot of folks in retail and tourism, which doesn't surprise me. And again, it's not to discourage anyone from saying new markets might not be a viable path, but it's certainly something to be aware of. Lots of healthcare organizations, some industrial stuff, and then some folks who are saying others. So the good news is new market can be used for just about anything. My colleague will talk about what it can be used for. But with that, I'll pass it over to my colleague to tell you a lot more about what equality is.
Well, thank you for that introduction there and getting everybody ready for the next part of our presentation. I'm going to cover what makes a particularly attractive Qualic B. And the main reason is to think all the time that this is a competitive process. You're trying to compete with other projects. That doesn't mean that your project, just because it doesn't happen to be in the highest category, wouldn't work. But it's all about what the story is and how you explain that to CDs and investors and how you tailor your approach to the specific CDs and investors that you're talking to at a particular time, because all of them have their own footprint, if you will. This is why sometimes it's probably advised that you do have consultants that help you go through the process if you don't have a long experience base with it. So the first question is, do you have a Qualic B? Again, we've created this acronym to make you feel a little uncomfortable, but it's basically the part of the project that's in the special purpose entity that you control, which has all the activity. So you set up a corporation, that's the basis of it, and you consider several things in how that's done. It can either be a nonprofit or a for-profit entity. You look at location, you look at the income in the area that you're serving, what type of services you're bringing, and you pay attention to make sure that you meet any criteria that are required by the IRS statute, which is 45D if you want to look it up. So for instance, you have to have less than 5% of assets that are collectibles, and you do the tests such as the non-qualified financial properties test. But this will all be, you can get assistance from a specialized consultant to help you, and also attorneys that are particularly adept at doing this, and that will issue the tax opinion. Should mention that some project types are actually prohibited. We sometimes characterize those as sin businesses, for instance, a massage parlor, something like that. However, oddly enough, there's an item like the swimming pool, which is also in the same category. But there's a nuance with many of these aspects because 45D is rather short. So for instance, generally speaking, if you're just saying housing or agriculture, there could be a problem with that type of a industry that you're going to be doing. However, there are housing projects and projects that are involved with agriculture that can qualify, and that's where the nuance of what is defined as each of those industry sectors are important to consider. So what actually makes your project a good project? And again, this is about what is the current situation. because census tract is something that people always look at first. The reason being that a vast majority of the projects right now are qualified by the census tract. And we'll get into that in a little bit more detail, because there are at least a couple of categories you have to be familiar with, which show the degree of difficulty for economic development in that particular area. What you're looking for are the designations of severely distressed, or the relatively new one, which is now deeply distressed and will become more of a factor in the double round. You also want to look at the community impact and how this is going to be measured and evaluated by the CDs or the investors. In other words, a job is just a number if you just put it down as there's X number of jobs with your project, but are these quality jobs? Are they accessible to people in the community, or people looking for second chances or re-entering the job market? What about the benefit package? Is it good? Are you looking for living wages, or is it something that is not necessarily easy to make it for a family of four to be able to live with just a couple incomes like that? There's also what's called the but-for analysis. This is not in the statute, but it is used quite frequently by CDs and investors to demonstrate that you need the subsidy from new market tax credits in order to make your project work, and you're not sitting on a large reserve of cash that could easily help you get to the end. And then I think this is a very important thing to emphasize: timing. What we're talking about in timing is, are you really ready to go and start closing process? It's not a fun activity if you start and then you have to stop and start again. So you ask yourself questions of, do you have your site secured, or is that still under negotiation? If you have a real estate project, are there going to be holdups because of permits? Have you checked out things like any environmental issues, such as tanks that might have been buried a long time and never dealt with on a property? These are items that you want to think about ahead of time so that you don't have surprises as you go. Coming back to the issue of the census tracts, you should see on your screen a very colorful map, which has different colors that are indicating designations of census tracts by the Census Bureau. These gray areas are considered the areas that are ineligible. The ones that are yellow are eligible, and that has a certain parameter for the primary factors to qualify the tract. In other words, poverty has to be greater than 20% for one of the primary characteristics, or the median family income compared to the average that is applicable for that region or the state has to be less than 80%. Now, eligible is not one of the project designations that attracts a lot of interest from the CDEs. There's a lot of confusion sometimes because people will notice, well, if it's eligible, can I do a new market project there? There are certain circumstances where you can change the designation, but those, again, would probably require you having intimate knowledge of the program and hopefully some assistance of people who have already had to experience changing designations. The severe distress and the deep distress then increase basically the parameters for economic development to determine the desirability of your project. So if you're severely distressed and designated as such by one of the primary characteristics, it means that now the poverty level has to be greater than 30% of the population in that census tract. The area median income should be less than 60% of the average you're comparing it to, or the unemployment ratio is 1.5 times what the national average is. There's also designations of non-metro county high migration areas, and we will talk a little bit more about that in another slide to come. There are secondary factors. There are fewer of these than used to be the case. And if you meet any two of those, you can sometimes have a project which is qualifying for the next level in terms of eligibility. Just to give you one example, if you have a healthcare project, and if that healthcare project is in a census tract which is designated as medically underserved, that can be a secondary factor to help you possibly still make a project work well if it's in an eligible tract to get it to the next level. Deep distress is relatively new. We've seen it the last 2 years, and for the double round, there are going to be a number of CDs that have a large part of their allocation which will require meeting the levels for deep distress. These are indicated by the purple or dark blue, depending on how you see the screen, census tracts in this particular example. So now you have more stringent characteristics, such as poverty having to be greater than 40%, or median family income less than 40%, or the unemployment ratio would be 2.5 times what the national average is. There's a couple of other items just to emphasize about targeted geographies. For many CDs, it is particularly desirable to have a non-metropolitan census tract. That's how it's designated. It means it's rural. That's done by comparing the location under certain rules that the Census Bureau checks out for the metropolitan statistical areas that are relevant to where your location is. So it's sometimes not intuitive. You might think a very small town should be considered rural just by casually looking at it. But again, it's important to check this with what's done by the Census Bureau. Underserved states. Every year, there are 10 states which are designated the most underserved states. And this list, generally speaking, does not change dramatically. However, there are usually additions or deletions from the list to get a different set of 10 every year. So depending on the timing of when you're doing your project, you need to check whether or not you happen to be in one of these 10 states. If you're lucky enough to do that, that really helps you get to the finish line. Talking about targeted impacts, these are just some parameters around 2 items that are often characterized and that can be documented fairly well. Job creation. There are some CDs who've had a standard in the past of 100 jobs per 10 million of allocation. That's not a hard and set rule, but that's just to give you an example. And that can work often with certain industrial manufacturing opportunities. Or you can also take a look at community services, and that's basically saying, well, how many clients or people are you serving per 10 million of allocation? Again, these are just some parameters to give you an idea, but it depends again on the type of industry you're talking about. If you're doing a healthcare project versus an industrial manufacturing, you might have a lot of employees that have to have advanced education, primary care specialists, doctors, and other types of health professionals. So you're not going to see the same numbers of jobs. So there is flexibility there. This is not a defined rule, but it's important to pay attention to it and have that as part of your story when you approach CDs and investors. So what are the general outcomes that you're looking for? Well, if you have jobs, it's just not about the number. Are they accessible? Do they pay living wages? What about the benefits? If you're talking about goods and services, are they available in the location, or are you competing with other types of similar services and organizations that provide them? If there's no services of that particular nature, that can be very important. For instance, take a situation where you might be having a project that's a grocery store or that's a food bank. If that happens to be a designation of a food desert per the USDA standards for that designation. That's very important because it means that it's difficult for people to find those types of services and goods to be provided in the location. And then you want to pay attention to the particular CDE or the investor that you're talking to. So here are just some key insights that you should be thinking about. How are you defining mixed use? Just that general term shouldn't always be thrown out there. It depends what's going on. It's important to be able to explain the types of mixed use that you have in these situations. Are you with one of the more popular projects, healthcare or manufacturing? If not, is there a story behind it which is really going to grab the attention of particular CDs or investors that are trying to make a difference in communities? And how are you measuring the impacts? And what are the tenants that you're trying to help for different types of facilities? Here again, these issues matter. So as much research as you can do and find a way to make that important in your story will have a successful outcome and actually result in better net benefits generally for those types of projects. So make sure that you have your project ready to go. That's the basic conclusion, that you've thought about these items ahead of time, you have your story, and you're ready to go out and actually get a deal for closing. So this is just a graph to show you some of the items that we've talked about here to find a really ideal project. What are your impacts? Do you have everything together? Is your capital stack put together? Do you have the facility already negotiated, or are the services available? Are you in a underserved state? Is it non-metro? These are the types of questions you want to ask, and my colleague Joe is going to go into further detail about how you get to the next steps. So I hope this will give you an idea of how you can look at the project and be very competitive in your analysis. Here's the next polling question. So if you can take the time to answer this, go for it. Do new market tax credit transactions require additional funds beyond NMTC equity to be involved?
And while people are answering their poll question, please remember that you can submit any supplementary questions via the chat function, and we'll try to get to those at the end of today's discussion. So, okay. All right, well, good. It looks like some of our information is beginning to sink in. So yes, you do need to bring other sources of funding into a new markets transaction. And we'll cover that here. Again, we'll revisit that here in a little bit more detail. But I'm here today to talk to you all about kind of what does it take to complete a new markets deal. And some of this will re-emphasize some of the points that both Trevor and David had made. But I want to make sure we're kind of putting it in the lens of how do we compete and how do we complete this transaction. So it can't be emphasized enough that new markets is competitive. And there are more projects out there like yourselves seeking the benefit than there is actually benefit available. And so in that environment, it's really important to understand what are your strengths? What are the things that David just talked about that you do particularly well? Alternatively, what are the things that you or your consultant or your team know that you might not stack up as well against? And how do you talk about those things? And maybe they're unique to your situation. So having lower impacts, but maybe more quality impacts in your region is the answer to some questions you might get. It's always good to have those answers up front. Like David said and Trevor said, new markets is heavily driven by timelines. These CDEs look to the Treasury Department's application guidance as well as their allocation agreement to understand when they need to get the new markets allocation deployed into communities. And your position relative to those timelines can greatly impact whether or not you will attract allocations to your transaction. Additionally, you want to put on a good face. You want to demonstrate to CDEs that you understand what is going on in a new markets program, and that you, in particular, understand the mission or the drive of the CDE. Now, CDEs have different missions. Some of them like to do nonprofits, some of them like to do manufacturing, some like food, some like healthcare. And some will only do certain cities, certain states, certain regions, or maybe they're national. And it is fairly difficult to walk up to the new markets industry and immediately understand who's going to do what. And so that's where another spot where a new market tax credit consultant like us at Cherry Bekaert can help you kind of sift through that information and get you to quicker answers. All of this to say is, through better organization, through timeline awareness and strength and weakness awareness, you are going to need to outshine your competition. So when you think about that idea of outshining, one of the concepts that we've talked about is readiness. What is the nature of your business? Are you an upstart or are you an ongoing business? If you're an upstart, you should be prepared to answer some additional questions of, why do you feel like your projections of revenue or service numbers are quality? Why do you think you'll be able to raise for-profit revenue or nonprofit fundraising? What have you done to investigate your site? Do you control it already? Have you investigated any environmental hazards that are there? Have you looked into the geotech to understand whether or not your site can actually support the investment that you're going to place upon it? Those things are timely, and having not done them will cue at least one minor red flag to the CDEs, and you want to avoid queuing at any of those if you can. Additionally, you're going to want to understand, or they will want to understand, where are you with your GC? Do you have a signed contract? Do you have plans and specs from your architect? Where are you with permitting? All of those third-party deliverables that aren't in control of you directly or the CDE or the investor are all things that they'll want to know are either complete or well into the process. We also want to understand whether or not your GC, your architect, etc., are aware of new markets, because they will get involved later on when we talk about dispersing. Finally, if you're a project that is going to be leasing out space to third-party tenants, you're going to need to understand what those tenants are going to do, because your tenants also cannot operate a SIN business inside of a new market space. But more importantly, the CDEs and investors are going to understand, how are you confident that you'll be able to charge revenues from identified tenants to support the new markets transaction? I think most importantly, though, is, are your other pieces of financing ready? This is probably the biggest cue to CDEs that you are organized and ready to go. Because as we've said, new markets is just part of the financing puzzle. And it's generally the last piece of the puzzle that gets put into the complete project. We want to see that your commercial debt, your grants, all of those things are committed. And we'll talk about what committed versus kind of ready to go in hand cash means for different levels, but we need to understand the idea of commitment and identification. So you've seen this slide before, but let's reemphasize here where we need to see cash available versus kind of commitments for future obligations. In the top left corner is where you and your leverage partners need to be prepared on the day of the new market's closing to fully advance the 70% of the capital stack here into the transaction. So this isn't a gradual disbursement like it is on a traditional construction loan. This is a full advancement of your 70% of proceeds into the new market structure. On the other hand, in the bottom left-hand corner, where you have funds that are contributed directly to your project that don't route through the new markets scenario, those need to be committed. They don't necessarily have to be cash on hand, ready to invest into the transaction or spent on the transaction, but there needs to be a firm commitment. That could be a signed loan agreement. It could be any number of things that show these funds will be available when they are called upon to complete construction or investment into the new markets transaction. We'll skip over that. So I think it's important, whether you're sitting in the top left-hand corner, which is the blue box here, or the bottom left-hand corner, which is the green box, those capital providers, again, need to be prepared and organized for what new markets is going to ask or impose upon them. And because, like David said, you don't want to start a transaction, hit one of the topics that are listed in each of these boxes, and then realize you have to hit the brakes. Because as I'll show in a later slide, hitting the brakes drags out the timeline, and increases the cost of your transaction. I think for leverage providers, there's many key components here that I've listed out, but the one I really want to focus in on is the concept of forbearance, the second bullet. In new markets, the leverage loan is a loan to the investment fund. And the investment fund is owned by the investor, and that is the mechanism that allows the investor to receive their credits. If for some reason the bottom of the structure, the qualic B, is unable to make its interest payments up to the CDE, up to the investor, and then out to the leverage lender, your leverage loan will not be eligible for foreclosure or taking ownership of the investment fund. That is a hard, red, bright line for the investors. It's just something they will not budge on. And you don't want to find out that your source of leverage loan, whether that's a third-party debt provider or government agency, whatever it may be, you don't want to find out midway through that they will not accept that as is, or that they need extra time to kind of consume that. When you switch over to direct funding, a lot of these items are kind of more traditional. What is the collateral for your direct investment? What is their collateral position against the collateral position of the new markets lenders via the Quilliggy loans? You want to make sure that people have thought about what they need or what they can give to make sure that both the Quilliggy loans as well as the direct funding can play in the same transaction sandbox. Now, we've talked about cash, we've talked about capital campaigns, we've talked about kind of traditional commercial debt, and those are often great sources for a new markets transaction. But similar to new markets, there are other sources of subsidized funding that often come into new market tax credit transactions. Similar to new markets, you need to be aware of the timelines that come with each of these topics. And so although I cannot go through all the requirements of HTCs, USDA, CDBG, and CPACE, what I do want to alert you to is some of the timing considerations, because this all links back to that idea of committed funds. So if you think you're going to bring in HTC funds, but yet your building is not on the National Registry, or you haven't done a full kind of HTC appropriate plans and specs, or you haven't begun with your state SHPO or the MPS process, it's going to impact your new markets timeline. And again, timelines are important in the new markets award cycle. Similar for USDA loans. These are very popular products that help subsidize and bring about many new markets transactions. But given a lot of the change at USDA and the broader federal government, we're seeing delays in many of these sources as they kind of work their way through their approvals. So you want to factor in additional time when you're talking to USDA. Similar for CDBG and HUD, you need to make sure that your local community authority that has or will apply for Section 108 is actively working with the HUD authorities to make sure they understand this is going for new markets, because it will trigger a secondary or elevated review. And finally, for CPACE, this is a form of financing for energy efficient improvements or investments on your property. You want to make sure that new markets and CPACE are funding different costs. You want to make sure you're not kind of double funding one asset. And additionally, and I think probably the thing that gets talked about the most, is whether or not your other lenders who are lending directly to your qualic B, how comfortable are they with CPACE coming in and essentially jumping to the front of the line as a property tax assessment? Some lenders get very nervous about the ability of the project to carry that additional debt via the property tax assessment. So let's assume that we've got our readiness, our organization together. What are the other critical elements that jump you into the closing process? The key element there is term sheets from CDEs and term sheets from the investor. Term sheets from the CDEs are going to be very straightforward. Here's the amount of allocation we are willing to reserve for your allocation. Here are the fees that we are going to expect to be paid on the day of closing and annually thereafter. And then additionally, here's how long we will hold this reservation for you, because they want these deals to get closed. They don't want them to linger out there forever. So they do put kind of a back end or limitation on how long they will let a deal simmer before it actually closes. An investor letter is similar. They will list the price of credits that they will pay for a transaction. They'll say even we'll do transactions up to a certain number of allocation. They may also include fees if they have loan servicing fees or fund management fees. But both the CDE and the investor will also contain the idea of guarantees. What are the things that they are going to expect if you break the new market tax credit rules? Now you've gotten to the stage, you've got your reservation, you've got your investor, you have ideally been working with Cherry Bekaert, and you still need other third-party professionals to carry you through now the nitty-gritty, the heavy carrying of the transaction. So we are going to introduce you, and you should always have experienced counsel and experienced accountants engaged on your side. Experienced counsel generally should be someone who does new markets day in and day out. This should not be your local practitioner who has heard of new markets or is interested in doing new markets. That is a recipe for incurring unnecessary and additional legal costs when certain things that are expected in new markets don't appear in the legal documents, or things that aren't allowed in new markets appear in the transaction documents. You don't want to be paying for your attorney's learning curve. Similar for the accountants produce a very in-depth model that shows all the cash flows on the day of closing, all the cash flows and accounting treatments afterwards. You want to make sure that this is an accounting team that does this day in and day out. And in the new markets industry, there's only a handful of accounting groups that many CDEs and investors will allow to be present in a transaction. So we've gotten all your elements together, your term sheets, your third-party support professionals. You're now in the closing process. What is that going to look and feel like for you? Well, the kind of the key element that almost all new markets transactions that share is the concept of a weekly or regularly scheduled closing call. This is where you and your professionals, accountant and attorney, CDE and their counsel, and investor and their counsel, will all join a regularly scheduled call to walk through potentially hundreds of individual items that they will all require to close the transaction. So we're talking due diligence on your real estate. We're talking equipment purchase contracts. We're talking loan agreements, guarantees, promissory notes, etc. And so we use those calls to inventory all those items, get status updates on where draft items are, and then work through any deal nuances. Now, although these calls are typically run by the investor or their counsel, I always come to the call for my clients with my own talking points or agenda. And I always encourage my clients and CDEs to start the calls that way as well. Because what we want to do is make sure that no item or confusion or update gets missed that unintentionally drags out the closing process. Because as you can see at the bottom of this slide, timeline is the #1 driver of transactional costs. The longer it takes you to start these closing calls and to wrap them up with the funding, the more expensive your legal and accounting bill will likely be. Now, there's always exceptions here. There's always deals that you hear about that they closed in a miraculous 2 weeks or 3 weeks. Or you hear about horror stories where, gosh, it took 6 months to close a transaction. Those are the outliers. I think most transactions, in my experience, take somewhere between 6 to 10 weeks of regular weekly calls to actually get you from kind of initiating stage to actually moving funds into your disbursement account. And that's the goal here. We want to move money. We want to get you a benefit. But there's some mechanics there. Namely, do you have the right bank account set up at the right organization? Because this really does move funds. These aren't just mere accounting treatments when we talk about the 70% and the 30% running in. We are moving funds. So in most cases, the investor is a large regional or national bank. They will set up all the necessary accounts for that deal diagram. What is expected of the sponsor team is to make sure that their 70% of the funds are ready and available, ideally the evening before the transaction, but certainly by the morning of the transaction. And they are advanced into your bank account at the investor bank. Once that is there, and once the attorneys give the green light that all the legal documentation is ready, the investor takes over, and they're going to execute a series of wire transfers on a document typically called the flow of funds that is agreed and signed upon by everyone, so everyone knows where the money's going. But at the end of the day, it results in your net benefit of true cash proceeds arriving in your bank account at the Qualic B to be spent on their intended purpose. But you can't just spend the money without oversight. So there is a disbursement process involved in new markets. You can't simply walk up to the retail branch of your investor bank and say, hey, I need a $500,000 check to pay for this piece of bakery equipment. You need to honor and go through the process that's outlined either in your loan agreement or the dispersing agreement. And what those requirements generally are going to say is, hey, you need to produce an invoice, you need to produce lien waivers if those are appropriate, you need to produce an updated budget showing balanced sources of funds with expected uses of funds, and related materials. If you submit those to your CDE, they can make a timely review and either suggest approval, whereby the investor bank releases the money to you to pay your bills, or they may request additional information. But they will certainly request additional information if you submit an incomplete package. So again, this concept that we've been hitting on all day of being organized, being ready, it carries through even after you've completed the funding. Now you've built your building, you've built or purchased your equipment, and you're done requesting disbursement of funds. Kind of what should you expect during the next 7 years? Generally speaking, keep doing what you're doing. Do the thing that brought the CDEs and the investor to your transaction. You want to make sure that you're performing as you had promised. You want to make sure that you're reporting out, hey, we said we were going to hire 50 new people. Well, we hired 52. Perfect. But even if you only hired 45, that's not an event of default for new markets per se. What would be a problem is if you refuse to share that information with your CDE partners. So you always just want to report out. Also, these are loans. These are interest-only loans for 7 years. So you're going to make sure you're making your regular interest and fee payments up to your CDE. Finally, what happens if you have an unexpected change? Say something changes the nature of your for-profit or nonprofit business. New Markets is not a loan product that's in a gotcha mentality. These CDEs and investors are motivated to provide impacts and keep investments in low-income communities. They will work with you if you're having a challenge. The idea is constant communication. Bring them into the loop, form a relationship with them so that you guys can work together to kind of sort things out if something needs to change in the way you approach your business. And although it didn't make it onto our slides today, I want to just emphasize at the end of the 7 years, there is an unwind process. And this is the process whereby the investor gives you the option to purchase them out of the transaction. And that's generally for $1,000 plus attorney's fees, which are relatively minimal at that stage in the game. Once you purchase the investor out of the transaction, the CDE will then withdraw themselves. And when they do that, you're left in a situation where your leveraged lender entity is now the lender to your Qualic B entity. And this is where New Market's second benefit comes into play. Because your two loans, as Trevor said, they're proportionate to each other. Your A loan was offsetting your leverage loan, so that just kind of nets out to zero. But your B loan, that's where the secondary benefit is. You get to cancel that out. And so all of a sudden you have that much less debt on your Qualic B books or that much more equity, however you want to view it out. So you get the cash up front, and then you get a nice equity boost at the end. So for all those reasons, we think New Markets is an attractive project. We would like to be your guiding coach through this process. And I'll take you into our last polling question, which is whether or not you would like to explore using New Markets on your upcoming transaction. So while the polling question is up, if people have any specific questions they would like to put into the webinar chat, please do so. We have a few minutes here, and we thank you for your time, and I'll also kick it back to Laurel to kind of close us out.
Thanks, guys. That was a great informative session. I hope everybody learned a lot during our last 50 plus minutes together. This concludes our webinar today. Thank you again for joining us. If you have any questions, please feel free to reach out. Any of us are available to you, and we'd love to hear from you about a project, a question. No commitment on your part is necessary. Just reach out and we'll help you through the first step of finding out whether you actually have a project that would qualify. Have we gotten everybody to get their polling question in?
Let's give them one more moment, Laurel, and then we'll
Great.
see the results. And then I think
While we let everybody get that last polling question answered, I wanted to just remind everybody, put a plug in that we have our next session coming up in July 31st at noon. I believe that's noon Eastern time, 11 Central. The next session will be Empowering Communities, the CDE approach to new market tax credits. So we've talked about new market tax credits from the project perspective in this session, and that next session will be from the CDE's perspective, which I always encourage people to come to that, even if you're not a community development entity or a CDFI, because if you are interested in new market tax credits, it's important to learn what you're trying to attract. We value your feedback, so you should be on the lookout for a short survey that will be coming into your inbox. I think that you'll have an opportunity to take that survey at the end of this session, and you'll probably get an email reminder if you don't do it today. And the last reminder for you before we send you off on your Thursday and encourage you to enjoy the rest of your weekend into the weekend is to remind you that this session will be able to be viewed if you missed anything. All these sessions and recordings are available online. So not just this session, but other sessions that might be helpful to you, done by our team and others at Bekaert. We hope to be your guide in this and other matters. So please feel free to reach out, and we hope you've enjoyed your time with us. Thank you so much.